Let's be honest, does checking your stocks sometimes feel like you're pulling the lever on a slot machine? If it does, you're not alone, but that's exactly why so many people lose. So in this explainer, we're going to show you how to stop gambling and start investing. We're going to give you the tools to move from just making risky bets to actually owning a piece of the world's best companies.
So, here's our game plan. First, we're going to bust a really expensive myth about the market. Then, we'll get into what you're actually buying and, maybe more importantly, where you're buying it. After that, we'll decode the market scoreboard and then build you a winning strategy that actually works for the long haul. You ready? Let's do this.
All right, let's jump right in. What is the #1 reason most investors fail? Simple. They treat the stock market like a casino. You see all those flashing reds and green numbers, the breaking news alerts. It's all designed to feel urgent and exciting, but thinking like a gambler is pretty much a guaranteed way to lose your money.
So, I want you to completely change your perspective. We are swapping that slot machine for a shopping cart. From now on, think of the stock market as a giant global supermarket. You're not there to bet on squiggly lines. You're there to thoughtfully buy shares of the world's greatest companies. You're adding a quality product to your cart for the future.
Okay, so if it's a supermarket, what's actually on the shelves? Let's talk about the merchandise. We need to break down what a stock really is, because trust me, understanding this is the absolute key to being a smart investor instead of a gambler.
So, a stock is really just your slice of the pie. Or think of it like a slice of a giant pizza. When you buy one share of a company, you're not just a customer anymore, you're an owner. Yeah, a tiny owner, but an owner all the same. Your money is helping that company grow and innovate, and in return, you get to share in its success.
And there are two main ways you get paid as an owner. The first is capital appreciation. This is when the company does well, and your slice of the pizza gets bigger and more valuable. You buy it for one price, and later you sell it for a higher one. Easy enough. The second way is through dividends. This is like the pizza shop being so profitable that every 3 months, it just gives you, a part owner, a little bit of cash as a thank you.
But, and this is a big but, ownership comes with risk. If that company you own a piece of starts to struggle, well, the value of your slice struggles right along with it. Your potential for reward is tied directly to how well that business does. And if it goes bankrupt, you're the last one to get paid. The banks and the big lenders, they get the life jackets first.
All right, so we know what a stock is. Now let's talk about the arena, where you actually buy it. You know, it's a super common misconception that when you hit buy on your phone, your money goes straight to Apple or whatever company you're buying. That's not usually how it works. Let's clear this up right now. Check out this table. The primary market is like a new car dealership. It's where a company creates and sells its shares for the very first time. This is called an IPO, or initial public offering. In that case, yes, the money goes right to the company. But almost every trade you'll ever make happens on the secondary market. This is like a giant global used car lot where investors just trade existing shares with each other. So when you buy a share of Apple, you're not buying it from Apple. You're buying it from some other investor who decided to sell. So why does this even matter? One word, liquidity. It's just a fancy word that means you can easily turn your shares back into cash by selling them whenever you want, as long as the market is open. Without this massive secondary market, investing would be a nightmare. You'd be stuck holding on to your shares until you could find a specific person you wanted to buy them from you. You hear it on the news every single day, right? The market is up, the market is down. But what in the world is the market? It's not a physical place. It's really just a scoreboard that measures the overall performance of stocks. So let's take a look at the scoreboard everyone's actually watching.
9 times out of 10, when someone talks about the market, they're talking about the S&P 500. It's an index that tracks 500 of the biggest and most important companies here in the US. It basically gives us a quick snapshot of how corporate America is doing on any given day. If the S&P 500 is up, it's generally a good day.
But here's the catch. Not all 500 of those companies are treated equally. The index is market cap weighted. All that means is that the bigger the company, the more its stock price movement affects the overall score. So a tiny little move by a giant like Microsoft can swing the entire index way more than the huge jump from one of the smaller companies on the list.
So yeah, we're talking about 500 huge, influential companies. I mean, together they make up something like 80% of the entire US stock market's value. But because of that weighting system we just talked about, the performance of the index is actually driven by just a handful of players. And this chart really says it all. Right now, a small group of massive tech companies, people are calling them the Magnificent Seven, they make up about a third of the entire S&P 500's weight. That's insane. It's like having a basketball team where one superstar player is scoring a third of all the points. You have to understand this to know what's really driving the market.
Okay, we've covered the merchandise, the arena, and the scoreboard. Now for the really good stuff. How to build your winning game plan. And this isn't about some hot stock tip or trying to perfectly time the market. It's about building a simple, effective portfolio that actually fits your life.
So here's a really simple rule of thumb to get you started. It's called the rule of 120. All you do is subtract your age from 120, and that gives you a rough idea of what percentage of your investment portfolio should be in stocks. Now, it's just a general guideline, not gospel, but the idea behind it is powerful. The younger you are, the more time you have on your side to ride out the market's bumps.
And this table just shows you how that might look over time. See? When you're younger, you're in growth mode, heavy on stocks. As you get older, you slowly, gradually shift more towards stabler investments like bonds to protect the money you've already made. Just think of it like this. Stocks are like owning a business, while bonds are like loaning money to a business. Loaning is almost always safer.
Now, there are two main ways to go about this. You can be an active investor trying to be a genius and handpick stocks to beat the market. Or you can be a passive investor and just try to match the market by buying something like an S&P 500 index fund. Here's the kicker. Active investing costs more, and get this, over any 10-year period, more than 80% of professional fund managers fail to beat a simple, cheap, passive index fund.
And hey, don't just take it from me. The absolute legend Warren Buffett, arguably the greatest stock picker who ever lived, has said over and over again that for most people, the smartest thing you can do is just buy a low-cost S&P 500 index fund and call it a day. Coming from him, that says a lot.
Okay, finally, let's talk about maybe the most important part of all of this, your mindset. This is the part where your own brain can become your biggest enemy. You have to remember, it's not about timing the market, it's about time in the market. This is a marathon, not a sprint.
This chart right here tells the whole story. Look at the last 20 years. You can see these absolutely terrifying drops. The dot-com bust, the 2008 financial crisis, the pandemic panic in 2020. I mean, in the moment, each one felt like the end of the world. But when you zoom out, they're just little bumps on a long, upward-sloping road. The long-term trend is growth, and patience is your single greatest weapon as an investor.
So let's wrap it up with a quick checklist. First, know the market hours, 9:30 a.m. to 4 p.m. Eastern Time. Don't mess with after-hours trading. It can get really wild. Second, burn this into your brain. It's a long-term game. And finally, check in on your plan every so often as your life changes. Got it? Good.
So I'll leave you with this one question to think about. Are you investing for the next 10 minutes or for the next 10 years? Your answer to that question changes everything. Think long-term, act like an owner, not a gambler, and you'll be on your way. Now, seriously, stop checking your app every 5 minutes and go for a walk.